Hi, let's continue with problems related to operating leverage and financial leverage. So let's look into three formulas. Financial leverage equals earnings before interest and tax divided by profit before tax. Operating leverage equals contribution divided by EBIT. Combined leverage equals contribution divided by profit before tax. So let's look into the question. A firm has sales of rupees 10 lakh. Variable cost is 20% on sales. Fixed cost 2,50,000. Debentures of rupees 5 lakh at 10% interest. Calculate operating leverage, financial leverage and combined leverage. So you should know that the formulas related to each leverage. Operating leverage equals contribution divided by EBIT. Financial leverage equals EBIT divided by profit before tax. Combined leverage equals contribution divided by profit before tax. So from this information, you know the sales. 10 lakh variable cost is 20%. 20% is charging on 10 lakh. So you will get contribution. Variable cost is deducting from sales. 10 lakh minus 2 lakh, 8 lakh rupees the contribution. Then 8 lakh contribution minus fixed cost 2,50,000. You will get EBIT 5,50,000. So operating leverage equals contribution divided by EBIT. 8 lakh divided by EBIT 5,50,000 equals 1.45. I'll repeat once again. Sales 10 lakh. Variable costs 2 lakh. So you deduct that. So you will get contribution 8 lakh. 8 lakh minus fixed cost 2,50,000. So you will get EBIT 5,50,000. So substituting in the formula, you will get operating leverage as 1.45. So what is financial leverage? Financial leverage equals earnings before interest and tax divided by profit before tax. So earnings before interest and tax, is it given or not? You already calculated that. 5,50,000. 5,50,000 EBIT less interest. What is interest amount? 5 lakh into 10 by 100, 50,000 you are deducting from EBIT. So that is known as profit before tax. So profit before tax, you get 5 lakh. So EBIT divided by PBT, 5,50,000 divided by 5 lakh equals 1.1. That is financial leverage. So here the combined leverage equals multiplying these things together. 1.45 into 1.1 equals 1.59. That is combined leverage. So this is a very important question. Degree of operating leverage, degree of financial leverage and combined leverage using the above three formulas. Next question. Calculate EPS. As you all know that what is EPS? EPS is known as earnings per share. It is calculated by using a formula net profit after tax divided by number of equity shares. Let's work out a problem. EBIT of a company is rupees 25,000. Tax is 50%. Number of equity shares in situation 1 is 5,000 and in situation 2 there are 10% 1,000 debentures of rupees 10 each and 4,000 equity shares. Calculate EPS. So as you all know that financial leverage tells that the usage of debt along with equity in the capital structure will magnify the return available to the equity shareholders. So let's check out whether the usage of debt with equity given maximum return to the shareholders or not with the help of EPS calculation. So EPS equals net profit after tax divided by number of shares. So first situation, how many shares? It's given here very clearly, 5,000 shares. What is net profit after tax under the first situation? EBIT is 25,000. EBIT minus interest. Interest is not given in the first situation. Why? No debentures. Only equity shares. So no interest. So 25,000 minus 0 equals 25,000 itself. Then you calculate tax on that 25,000. So 12,500 tax amount. So that tax amount is deducting from 25,000. So you will get profit after tax 12,500. So that's given here 12,500 divided by, under the first situation it's only equity shares, 5,000 equity shares. So divided by 5,000 you will get 2.5 as EPS under the equity scheme. Under the second situation, let's work out EPS. Under the second situation, what's the difference? You want to deduct the interest amount. What is the total debentures amount? 1000 into 10, that is 10,000. 10,000 into 10 by 100, that's the interest amount. So first you deduct the interest from EBIT. Then you deduct the tax. So you will get profit after tax. So that profit after tax is 11,500. But under the second situation, number of shares is 4,000. So 4,000 given here. And what is EPS? EPS is 2.875. So what is the difference between these two? Let's check out. First plan using only equity. So under this situation, EPS is only 2.5. But under the second situation, the usage of debt with equity gives maximum return to the equity shareholders in the form of EPS. Check out the EPS, 2.875. So it tells that financial leverage always magnify the returns available to the shareholders. That's all related to this problem. And next one is financial break-even point calculation, which is very important. Financial break-even point is known as the EBIT level at which no profit, no loss available to equity shareholders. Equity shareholders have no profit and no loss at a particular EBIT level. That level is known as financial break-even point. Let's work out a problem. A firm has to pay interest of rupees 30,000 and it has preference dividend of rupees 40,000 and tax rate is 50%. Find out financial break-even point. What is the formula to calculate financial break-even point? Interest charges plus preference dividend divided by 1 minus tax rate. That is the formula to calculate financial break-even point. So here the interest charges. Let's look into the interest charges. It's directly given. 30,000 rupees interest is already given in the question. So just rewrite that interest charges, 30,000 plus. What is the preference dividend amount given in the question? That is 40,000. So write it here, 40,000 divided by 1 minus tax rate is 50%, 0.50. So you will get financial break-even point as 1,10,000. What does it mean? So this is the EBIT level. If the company make EBIT of 1,10,000 rupees, this is the level at which the equity shareholders are in a situation of no profit and no loss situation. That's known as financial break-even point. Last question. From the information, calculate the combined leverage. EBIT is given, that is 10 lakh. Fixed cost is also given 20 lakh. And EBT is also given 8 lakh. All these informations are given. So what is the formula to get combined leverage? Let's look into that. Contribution divided by EBIT into EBIT divided by EBT. EBT means earnings before tax. This is the formula. So when you work out this, finally you will get or derive one particular formula for the combined leverage. What is that? Contribution divided by EBT is the formula to get combined leverage. So contribution equals, there is a simple shortcut method to calculate contribution. EBIT plus fixed cost is known as contribution. So you will get, if you add these things together, you will get contribution. So combined leverage equals contribution, this 30 lakh divided by EBT, 80 lakh. And you will get that much of amount, 8 lakh, not 80 lakh, 8 lakh. So you will calculate this combined leverage. Finally, it is 3.75. So this is the way you can work out the combined leverage. All these are the important questions. And last question is related to leverage. A firm has sales of rupees 40 lakh, variable cost 25 lakh, fixed cost 6 lakh, 10% a debt of rupees 30 lakh and equity capital 45 lakh. All these informations are given. Calculate operating leverage and financial leverage. If you want to calculate, you prepare a statement, sales, starting from sales. Sales minus variable costs. So you will get contribution. Contribution minus fixed costs, you will get EBIT. EBIT minus interest, you will get EBT. And substitute the things in the formula. Operating leverage equals contribution by EBIT. You get 1.67. Financial leverage, EBIT divided by EBT. So you will get 1.50. Let's work out this problem also. These are the most important questions which you can expect from financial leverage part. Thank you.